Good morning, sir. My name is Vina Puspita from Accounting Class D, and this is my video record to meet Accounting English. Basics of Accounting. Accounting is the practice of recording and reporting on business transactions. The basics of accounting can be summarized within the following points. System of record keeping. First, there must be a rational approach to record keeping. This means setting up accounts in which information is stored. Accounts fall into the following classification. Assets. There are items purchased or acquired but not immediately consumed. Examples are accounts receivable and inventory. Liability. These are their obligation of the business to be paid at the later date. Examples are accounts payable and loans payable. Equity. These assets minus liabilities and represents the ownership's interest of the owners of the business. Revenue. This is the amount billed to customers in exchange for the delivery of goods or provision of service. Expense. This is the amount of assets consumed during the measurement period. Examples are rent expense and wax expense. Transaction. The accountant is responsible for producing a number of business transactions. Will order are forwarded to the accountant from other part of the company. As part of this transaction, they are recorded within the accounts that we note in the first point. Key transactions are purchase materials and service, recruitment, the issues of purchase orders, and the payment of supplier invoice. Sell goods and services to customers. Records the creation of an invoice to be sent to its customer, documenting the amount owed by the customer. Receive payment from customer. Records matching received cash to open invoice. By employees. Records the collection of time work information from employees, which is then used to produce gross wage information, tax deduction, and other deduction, resulting in net pay to employees. Reporting. Once all of the transactions related to an accounting period have been completed, the accountant aggregates the information stored in the account. The reforms it into three documents that are collectively called the financial statement. The statements are: income statement. This document presents revenues and subtracts all expenses incurred to arrive at a net profit or loss for the reporting period. It measures the ability of a business to attract customers and operate in an efficient manner. Balance sheet. These documents present the assets, liabilities, and equity of a business as of the end of the reporting period. It presents the financial position of an entity as of a point in time, and is closely referred to determine the ability of an organization to pay its bills. Statement of cash flows. This document presents the source and use to cash during the reporting period. It is especially useful when the amounts of net income. Thank you, sir.